The bear case: earnings volatility, valuation constraints, and regulatory risk. While the operational foundation of CNQ is robust, the bear case focuses on a projected decline in profitability for 2026, the potential for a global oil surplus, and the looming costs of environmental compliance. Analysts increasingly view the current share price as having fully priced in the TMX dividend, leaving the stock vulnerable to a derating if global macroeconomic conditions deteriorate. Forecasted earnings contraction and margin pressure. The primary concern for bearish analysts is the trajectory of CNQ's earnings. Despite record production levels, full-year 2025 earnings per share, EPS, are projected to decline slightly, with a more significant 9.2% drop expected in 2026, bringing EPS down to an estimated $2.28 from $2.51. Several factors contribute to this negative trend. Commodity price normalization. Global oil inventories built up by 477 million barrels in 2025, and the IEA projects a continued supply surplus in 2026. This is expected to exert downward pressure on benchmark WTI and Brent prices.
Increased operating expenses. The 2026 budget includes higher non-cash costs and increased abandonment expenditures. Furthermore, 2026 is anticipated to be a year of higher turnaround activity, particularly at the Horizon facility, which will temporarily increase unit costs and suppress production volumes. Soft natural gas pricing. AEKO natural gas prices remain weak, and while CNQ is a low-cost producer, the gas segment provides less torque to the upside in the current oversupplied North American market. CNQ currently trades at a forward PE of approximately 14.5x to 18.8x, which is a premium to the industry average and its historical mean. This stability premium limits the potential for significant stock price appreciation. If the market begins to prioritize growth over consistency, capital may rotate out of CNQ and into peers like Suncor, which are currently undergoing more aggressive operational turnarounds and trade at lower valuation multiples. The regulatory loom, emissions caps and environmental liabilities. The Canadian regulatory environment remains a persistent headwind. The federal government's proposed oil and gas greenhouse gas GHG pollution cap aims for a 35% reduction in emissions by 2030 compared to 2019 levels.
While recent reports from the 2025 budget suggest the government may scrap the cap if carbon capture and storage, CCS technologies are deployed at scale, the underlying policy uncertainty continues to stifle long-term investment. The Parliamentary Budget Officer has estimated that to meet the legal upper bounds of the cap, upstream oil and gas production would need to be reduced by 4.9% by 2030, potentially lowering Canada's nominal GDP by $20.5 billion. For CNQ, this represents a risk to its long-term production growth strategy. To mitigate this risk, CNQ is a leading partner in the Pathways Alliance, a $16.5 billion CCS project intended to store 22 million tons of CO2 per year by 2030. However, the project is still in the front-end engineering and design phase and is contingent upon sufficient fiscal and policy supports from the government. Bearish observers point out that these multi-billion-dollar environmental projects do not add to production volumes, but are necessary merely to maintain the social license to operate. This represents a massive allocation of capital toward non-productive assets that could otherwise be returned to shareholders.
Global supply dynamics and the 2026 oil glut. The International Energy Agency, IEA, has warned of a significant global oil surplus in 2026, revising its oil glut forecast to 3.84 million barrels per day. This surplus is driven by resilient non-OPEC Plus production, particularly from the US, Brazil, and Guyana, which is expected to outpace global demand growth of roughly 850 kbd to 930 kbd. In an environment where global supply continues to outpace demand, high-cost or geographically constrained barrels are the first to be discounted. While CNQ is a low-cost producer within the Canadian context, its barrels still face longer transportation distances to global hubs than Middle Eastern or U.S. Gulf Coast producers. A sustained sub-$60 WTI environment would test the company's ability to maintain its aggressive share buyback program while simultaneously funding the Pathways Alliance CCS project and its $993 million annual abandonment program.
The bull case: infrastructure-led value capture.
The cornerstone of the bullish thesis for Canadian natural resources is its structural low-cost advantage and its status as a primary beneficiary of Canada's expanded export infrastructure. The company's portfolio is uniquely positioned to maximize margins through integrated asset management and a disciplined capital allocation framework that prioritizes shareholder returns above aggressive volume expansion. Structural advantage of long-life, low-decline assets. At the heart of CNQ's competitive moat is its asset base, which is characterized by a low corporate decline rate and minimal sustaining capital requirements. Unlike conventional shale producers in the United States that must continuously drill new wells to offset rapid depletion, CNQ's oil sands and thermal assets provide a steady production profile that spans decades. This allows the company to generate substantial free cash flow even in moderate price environments.
The recent operational integration of the Athabasca Oil Sands Project, AOSP, following the swap with Shell, has been a transformative catalyst. By assuming 100% ownership and operation of the Albion mines, CNQ has added approximately 31,000 barrels per day (BBDL) of zero-decline bitumen production to its guidance. This acquisition was not merely about volume, it was a strategic move to optimize unit costs. Historical data indicates that CNQ has successfully reduced unit costs at AOSP from approximately $38 per barrel to nearly $25 per barrel through operational efficiencies and the application of proprietary technologies. This cost reduction capability is a central pillar of the bull case as it widens the profit margin regardless of global oil price fluctuations. The 2026 budget of $6.3 billion is targeted at delivering a 3% production growth, which translates to an additional 50,000 barrels of oil equivalent per day, BOED. This growth is intentionally modest, reflecting management's focus on high-return, short-cycle opportunities while maintaining the flexibility to curtail spending if the commodity market weakens. The inclusion of $175 million for front-end engineering and design for medium and long-term projects suggests that CNQ is building a multi-year growth runway that is not reliant on speculative exploration.
The TMX paradigm shift, narrowing WCS differentials. For decades, the valuation of Canadian oil producers was suppressed by the WCS discount, a pricing penalty caused by a lack of pipeline egress that forced Canadian crude to sell at a significant markdown to the West Texas Intermediate (WTI) benchmark. The commencement of the Trans Mountain Expansion (TMX) project in May 2024 has fundamentally altered this pricing dynamic. TMX has increased the tidewater export capacity of Western Canada by approximately 700%, allowing producers like CNQ to bypass the saturated U.S. Midwest and reach higher-paying markets in the Asia-Pacific region and the U.S. West Coast. The impact on pricing has been immediate and profound. Before TMX, the WCS-WTI differential averaged roughly $18.70 per barrel. Since the expansion became operational, this differential has narrowed to an average of $12 per barrel. This narrowing of the differential is essentially a direct increase in the revenue per barrel for CNQ's heavy oil segment, which constitutes approximately 25% of its 2026 production mix. Furthermore, the existence of excess pipeline capacity has virtually eliminated the threat of apportionment, the rationing of pipeline space, which historically led to forced production shut-ins and extreme price volatility. For investors, this represents a significant de-risking of the company's cash flow profile.
Capital allocation discipline and dividend reliability. A defining feature of the CNQ investment thesis is its 25-year history of consecutive dividend increases, a record that surpasses global peers such as Suncor Energy and Cenovus Energy. Management's capital allocation framework is highly transparent. Once net debt targets are met, the company commits to returning 100% of excess free cash flow to shareholders through dividends and share repurchases. In the third quarter of 2025 alone, CNQ returned $1.5 billion to shareholders, part of a year-to-date total of $6.2 billion. The 2025 annualized dividend of $2.35 per share yields approximately 5.1% heading into 2026. This yield is supported by an exceptionally strong balance sheet, with a net debt-to-EBITDA ratio of approximately 0.9x and liquidity exceeding $4.3 billion. The company's ability to sustain these returns is a function of its low break-even costs. CNQ's oil sands mining and upgrading operations average approximately $21 per barrel, while thermal in situ costs are even lower.
This cost structure allows CNQ to fund its dividend and sustaining capital even if WTI prices were to retreat toward the $40 to $50 range, providing a level of defensive income that is rare in the cyclical energy sector. Strategic synthesis, benchmarking, and future outlook. To fully appreciate the CNQ investment case, it must be viewed in the context of its integrated peers, Suncor Energy and Imperial Oil. These companies share many of the same regional catalysts, such as TMX, but their internal dynamics and valuation profiles offer different risk-reward propositions. Peer comparison, Suncor and Imperial Oil. Suncor has recently emerged as a strong competitor for institutional capital following a successful mine improvement plan at Fort Hills and a transformative step change in upgrader utilization, which reached 99% in 2025. Suncor's strategy is increasingly focused on returning 100% of excess funds to shareholders, and its integrated downstream, refining, assets provide a natural hedge when crude prices are low, a feature CNQ lacks in its purely upstream-focused model. Imperial Oil, meanwhile, is often viewed as the most expensive in the group, trading at a PE of 24.7x and frequently receiving sell or underperform ratings from analysts on a valuation basis. Imperial's production growth at Carroll has been impressive, reaching record levels of 280,000 gross barrels per day in 2025, but its lower dividend yield, 2.14%, makes it less attractive to the income-focused investors who gravitate towards CNQ.
The divergence in EPS growth forecasts is notable. While CNQ is expected to see a decline, Suncor and Imperial are forecast by some models to grow earnings as they capture the full benefit of recent operational restructurings and refinery debottlenecking. This suggests that CNQ's premium for consistency may be tested if its peers can prove they have closed the operational gap. The natural gas acquisition strategy. A potential wildcard for CNQ in 2026 is its ongoing M&A activity in the natural gas space. Reports indicate that the company is in discussions to acquire a $1 billion natural gas portfolio from Tourmaline. This would be consistent with CNQ's history of counter-cyclical investing, acquiring assets when commodity prices are depressed. Increasing its natural gas footprint would position CNQ as a primary supplier for the emerging Canadian LNG industry, providing a critical avenue for volume growth as oil sands production nears capacity limits. Conclusion: Canadian Natural Resources enters the 2026 fiscal year in a position of operational strength, yet its investment thesis is becoming increasingly nuanced.
The bull case rests on the structural dividend provided by its low-cost assets and the permanent improvement in WCS pricing brought about by TMX. For investors seeking yield and balance sheet security, CNQ remains the gold standard of the Canadian energy sector. However, the bear case cannot be ignored. The projected earnings contraction, the premium valuation, and the massive non-productive capital requirements of the Pathways Alliance CCS project represent significant risks to total shareholder return. In a world characterized by an oil surplus and an accelerating energy transition, the stability premium assigned to CNQ may be at risk if the company cannot find new avenues for margin expansion beyond the TMX-led recovery. For investors, the key monitoring points for 2026 will be the company's ability to manage its $6.3 billion capital program, the outcome of the natural gas acquisition talks, and the evolution of the federal emissions cap policy. While CNQ remains a foundational holding for energy exposure, its performance in 2026 will be a test of whether predictability can continue to outperform in an increasingly unpredictable global market.